Welcome to The Explainer, where we break down complex research into clear, engaging analysis. Okay, let's dive right into today's topic, which is a really interesting one. So let's talk about Tarsons Products. Now, you've probably heard of them. They're a huge player in lab equipment. But if you just glanced at their financials right now, wow, it looks pretty scary. And that's the big question we're trying to answer today. Is this a hidden opportunity, a real value play, or is it a classic value trap just waiting to spring?
I mean, just look at this. The first thing that jumps out at you is their profit. It has absolutely collapsed. We're talking a peak of 101 crores back in fiscal 22, and now, the last 12 months, it's sitting at just 20 crores. That's an 80% nosedive. You just don't see that every day.
And you know who's noticed? The so-called smart money. The big institutional investors are running for the exits. Foreign institutional investors have dumped their holdings, going from almost 10% all the way down to 2.5%. And the domestic guys, they're gone, completely out. So yeah, what on earth is happening?
Okay, so here's the thing. The answer to all this chaos, it all comes down to one single massive bet the company decided to make. And this bet, well, it's the very thing that's making their financials look so terrible right now.
They decided to go all in on the largest capital expenditure ever in the Indian labware industry. We're talking about an 800 crore rupee bet. That's about $100 million US. All of it poured into building brand new, state-of-the-art manufacturing plants.
But a bet that big, it doesn't come cheap, especially in the short term. To pay for all this, their debt just exploded. Look at that, from a tiny 22 crores to nearly 400. And on top of that, all these shiny new buildings and machines come with huge expenses, right? Things like depreciation and interest payments, and all of that goes straight onto the profit and loss statement, crushing those numbers we saw earlier. So here's the key takeaway. You can think of all these new expenses as a kind of capex tax that's hitting their profits right now. The company's basically paying the bill for all this future growth way before a single rupee of revenue from these new plants has even come in the door. Okay, but this is where the story gets really interesting. Remember that big depreciation number? That's a non-cash charge. It's an accounting thing. So what happens if we add it back to see what the actual cash profit looks like? Boom. It's more than 3 times higher than the reported profit. This is a huge clue that the core business, the actual day-to-day operations, might be a lot healthier than the headlines suggest.
All right, so if the core business is healthy, why take on all this pain and risk? What's the big idea here? Well, that brings us to the bull case. Let's dig into why someone would be optimistic about this whole situation.
The bulls, the optimists, they see a company playing the long game. They argue that Tarsons is using its dominant position in the market to build a massive competitive moat, something that could protect them for the next decade. These new plants, they're gonna double the company's revenue potential. And even more exciting, it lets them jump into really high-margin areas, taking the fight directly to the big global players like Thermo Fisher and Corning. And what gives them the confidence to do this? Well, it's the stability of their existing business. Just look at this mix. Over half of their sales come from consumables. You know, the stuff labs use up and have to buy again and again. It's like a subscription model for lab supplies. That creates a really sticky, reliable revenue stream, which is the perfect foundation to build this kind of ambitious growth plan on. You know, this quote from the research note we're looking at just sums it all up perfectly. Tarsons is deliberately absorbing short-term P&L pain to build a 10-year competitive moat. It's short-term pain for long-term gain. That's the whole bull thesis in a nutshell.
Okay, that all sounds great, but let's not get carried away. This is a massive, high-stakes gamble, and there are no guarantees. So now we have to look at the other side of the coin, the bear case. And believe me, the risks here are very real. The number one worry for the bears is all about execution. I mean, it's one thing to build a fancy new factory. It's another thing entirely to get customers to actually buy what you make in it. It's not a if you build it, they will come situation. If that revenue doesn't show up, Tarsons could be stuck under a mountain of debt and fixed costs for a very, very long time. And look, this isn't just some hypothetical fear. The company's track record on this project isn't great. They've already missed major deadlines for getting the new plant up and running. They told investors to expect meaningful revenue by now. And what have we got? Pretty much zero. That kind of thing really hurts management's credibility. So this is what it all boils down to, according to the analyst's valuation. Look at the scenarios. If the bears are right and the new plant is a bust, you could lose about 26%. But If the bulls are right, and it's even a partial success, you're looking at a 35% upside. And if it's a home run, the stock could more than triple. That's a really skewed risk-reward. It's very asymmetric, with way more potential upside than downside.
So we've seen the good, we've seen the bad. After digging through all of this, what's the final takeaway from the analyst? Well, this scorecard tells a really interesting story. You've got a strong underlying business, that's the moat, but it's sailing through a pretty nasty financial storm right now because of that capex. The analyst sees this as creating a favorable setup, a good risk-reward profile, at what looks like a reasonable price if you can handle the short-term volatility. And the final number? A 56.5 out of 100. Let's call it a C+. That puts it squarely in the keep an eye on it or maybe buy a little on dips category. It's really a call for patient investors, people who can look beyond these ugly, distorted earnings reports we're seeing today. And I think this last quote just nails it. The risk of permanent capital loss is low. The risk of time loss is high. What does that mean? It means you're probably not going to lose all your money here because the core business is solid. But the risk is that your money could be tied up for a very, very long time, waiting for this huge bet to actually start paying off. All right, before we wrap up, just a quick but very important disclaimer. The analysis I've shared here is purely for educational and informational purposes. I am not a SEBI-registered research analyst or investment advisor. Please remember, investing in the stock market comes with significant risks. All the data and charts you saw are based on public information and my own research notes. This is absolutely not a recommendation to buy or sell anything. You should always do your own research or talk to a SEBI-registered professional before making any financial moves. If you found this deep dive helpful and you want to get more stress-free investing analysis like this, please do me a huge favor and hit that subscribe button. And don't forget to ring the bell icon so you never miss an update. And finally, I really want to hear from you. Which Indian-listed company should I tackle next? Drop the stock name in the comments below, and it might just be the star of our next explainer. Thanks so much for watching, and as always, keep your investing stress-free.